Take a look at this price action. A cluster of trading days completely isolated from the rest of the market. It breaks away with a sudden gap in one direction, floats on its own for a while, and then violently gapping away in the exact opposite direction. This is an island reversal. It looks incredibly dramatic, but the hard truth in the data is that island reversals historically deliver mediocre performance. If you treat every isolated cluster on a chart as a guaranteed turning point, you will drown your portfolio in losses. We are going to fix that. By the end of this video, you will have a strict step-by-step checklist to spot valid islands, filter out the false breakouts using historical data, and perfectly time your entries. Mastering this specific methodology is what separates amateur gamblers reacting to shapes on a screen from disciplined traders who know exactly when to risk capital and exactly when to walk away. Step 1 is identifying the correct visual shape. An island top happens when prices gap up, consolidate for a period, and then gap down. An island bottom is the exact inverse. Prices gap down, drift sideways, and then gap up. This chart shows an island bottom. Notice the physical separation: an initial breakaway gap, a consolidation cluster, and an exhaustion gap. A valid reversal requires these gaps to overlap horizontally. Both gaps must be at least 25 cents wide, overlapping within 13 cents. During the island's consolidation phase, trading volume should trend downward, forming a U-shape or dome. The pattern is only confirmed if volume spikes heavily on the final breakout day, the day the second gap forms. We see this confirmation 79% of the time. If your chart is missing those exact 13-cent gap tolerances or the heavy breakout volume, you are looking at random market noise. You must move on to the next stock immediately. Step 2 is filtering out weak setups. Start with duration. You want to avoid highly volatile one-day reversals entirely. A valid, tradable island should last anywhere from 2 days to a maximum of 3 months. But the most critical filter is evaluating the prior trend context. Look at this chart again, specifically panning to the left. A reversal pattern must actually have a prior price trend to reverse. Here, we see a steep multi-month decline, leading straight into the island. If you spot an island forming right after a flat sideways consolidation, do not trade it. That is a trap. The price will immediately run into extensive historical support or resistance, and the momentum will die. Ruthlessly discarding overly long islands and avoiding flat trend contexts is your best defense against getting trapped in a stagnant, money-losing trade. Step 3 is setting realistic expectations by looking at the historical performance data of island tops versus island bottoms. Island tops are decent performers, experiencing an average decline of 17 to 23% following the downward breakout. Island bottoms, however, are highly disappointing. They average a weak 23% rise, falling far short of the 35% target we want for bullish patterns. To mitigate these weak numbers, you must trade in strict alignment with the broader market trend. The rule is simple: only go long on island bottoms during a broader bull market, and only short island tops during a broader bear market. Knowing these statistics protects you. It prevents you from holding on to positions too long, ensuring you lock in your profits before the notoriously weak momentum of an island bottom fades. Step 4. Calculate your target and time the entry. We use the measure rule. Find the highest high and lowest low within the island. Subtract the low from the high, and add that difference to your breakout price. Now, when do you actually execute the trade? The most common rookie trap is buying the stock immediately on the day of the breakout gap, hoping for an instant ride to the top. Statistically, 60 to 75% of the time, prices will reverse direction and quickly fill that gap, an event called a pullback or a throwback. You need to exercise patience. Wait 1 to 2 weeks for the price to return to the formation before taking any action. This chart shows how to manage entry. Draw a trend line over the throwback price action. Wait for the daily price to officially close above that downtrend line. If it merely pierces the line but fails to close above it, walk away. Patience is your edge. Waiting for the throwback and demanding a confirmed trendline break turns a high-risk mediocre pattern into a calculated high-probability setup. Let's bring this all together into your final checklist. 1. Verify both gaps overlap within 13 cents horizontally. 2. Confirm a steep prior trend to reverse. 3. Ensure the island lasts between 2 days and 3 months. 4. Wait for the pullback and buy only on a confirmed trendline break. Following this strict, data-backed process replaces subjective impulses with a set of objective requirements for your trading. By verifying your gap levels and patiently waiting out those inevitable pullbacks, you can navigate this tricky pattern with supreme confidence. Please remember, trading stocks and chart patterns involves significant risk of loss and is not suitable for all investors. The performance data discussed is historical and does not guarantee future results. This video is for educational purposes only and should not